They have made investing look like a game reserved only for the wealthy or the experts on Wall Street. But the truth is, you don't need thousands of dollars or a financial background to begin growing your money. What if I told you that starting with just $5 could open the door to long-term wealth? And no, this isn't some risky crypto gamble or a flashy shortcut that disappears overnight. This is about taking simple, smart steps that actually work even if you've never invested a single rupee in your life. You won't find complex jargon or boring lectures here, just a practical, easy-to-follow guide built for beginners who want real results. And here's the part most people overlook. Starting small doesn't hold you back. It actually gives you an edge when done right. If you stay with me till the end, I'll also reveal one bonus strategy that quietly accelerates your portfolio growth without adding any extra money. Welcome to FinTech Innovate AI, where we simplify personal finance to help you save smarter, invest better, and grow wealth without confusion. Section 1. The power of starting small. Most people delay investing because they believe small amounts won't make a difference. But starting with little money is not only possible, it's actually one of the smartest ways to begin. It helps you build confidence without feeling overwhelmed or scared of losing everything. Let me tell you a quick story. There was a young worker earning minimum wage who could only set aside $20 a month. Instead of waiting for a perfect moment or a big paycheck, he started investing that small amount consistently. 10 years later, his account crossed 6 figures, not from luck, but from steady contributions and compound growth. By starting small, he developed a habit, learned along the way, and built a strong foundation without taking big risks. This approach removed fear, taught him patience, and gave him real experience with money in the market. So don't underestimate the power of small steps. They create discipline, they grow with time, and most importantly, they get you started when others are still stuck waiting. Section 2. Breaking the fears that keep you stuck. Let's be honest, the idea of investing can feel scary when you're just starting out. Many people hold themselves back with thoughts like, I don't have enough money, or what if I lose it all? Some think they need to know everything before they begin, so they keep waiting. These fears are real, but they're also the reason many people miss out on years of potential growth. The truth is, you don't need to have it all figured out to take the first step. You just need the courage to start small and keep learning along the way. There's a story that perfectly shows this. A college student used to avoid investing completely because it seemed complicated and risky. She thought, I barely have money for groceries. How can I invest? But one day, she watched a simple video that explained the basics in plain language. She started with just $10, not much, but it was a start. Over time, she gained confidence, learned more, and kept investing little by little. Now, she not only invests regularly, but also teaches her friends how to do the same. The fear didn't disappear overnight, but it shrank every time she took action. So if fear is holding you back, remember this. You don't need to be perfect, rich, or an expert. You just need to start, and the rest will fall into place as you grow. Let's discuss the steps which helps to start investing with small amount of money or zero experience. Step 1. Set a clear financial goal. Before you invest a single rupee, you need to know why you're investing in the first place. Without a clear goal, it's easy to lose focus or chase things that don't align with your future. Are you investing to retire early? Is your goal to buy a home in a few years or to build passive income over time? Your answer shapes every step you'll take after this. When you set a specific goal that's realistic and time-bound, it gives your plan structure. Instead of just throwing money into the market, you're working towards something that actually matters to you. Let me share a story that shows how powerful this can be. There was a freelancer who had never invested before. He was tired of watching his money sit idle and slowly disappear due to inflation. One day, he decided he wanted to buy his first home within 5 years. That goal gave him clarity. He started setting aside money each month, learning about low-risk investments, and tracking his progress. He wasn't investing just to grow money. He was investing with a purpose. And 5 years later, he had saved enough for a down payment and made the purchase. That home wasn't just bought with money. It was built with discipline and a clear plan. So whatever your goal is, write it down. Make it specific. Give it a timeline. Because when your money has a direction, your decisions become much easier. Step 2. Choose the right platform to get started. Once you've set your financial goal, the next step is picking the right platform to start investing. This part can feel confusing at first, but it's actually easier than most people think. The good news is, there are beginner-friendly apps designed to help you invest even with small amounts. Platforms like Robinhood and Stash are simple to use and let you start with just a few dollars. If you're more focused on long-term investing, Vanguard also offers solid options, especially for ETFs and index funds. These platforms are built to guide new users, so you don't need to be tech-savvy or have any background in finance. One of the best features to look for is something called fractional shares. This allows you to buy a piece of a stock, even if you can't afford the full price. So instead of saving up hundreds for one Amazon or Tesla share, you can invest as little as $5 into it. This changes the game because it removes the barrier of needing big money to own strong assets. Let's keep it super practical. To start, download your preferred app, create an account, and complete the basic identity verification. Once you're set up, link your bank account and transfer a small amount you're ready to invest. Even $5 or $10 is enough. Now search for a stock or ETF that aligns with your goal. Tap Buy, choose your amount, and hit Confirm. Just like that, you've bought your first asset and officially become an investor. It's simple, beginner-friendly, and the best part is, the more you use the platform, the more confident you'll become. Step 3. Start with safe and simple investments. Now that you've chosen your platform, it's time to make your first investment, and this part doesn't have to be complicated. For beginners, the smartest move is to start with options that are both safe and simple to understand. This is where low-cost index funds and ETFs come in. They're perfect for beginners because they give you access to a wide range of companies in a single investment. Instead of picking one risky stock and hoping it performs well, you're spreading your money across dozens or even hundreds of companies at once. This concept is called diversification, and it's one of the most important ideas in investing. Think of it like this. You don't want to put all your eggs in one basket, because if that basket drops, you lose everything. But when you diversify, your risk is spread out and your investment becomes more stable over time. A great example is the S&P 500 Index Fund. It includes 500 of the largest companies in the US, all in one single fund. When one company struggles, others help balance it out, and that's what makes it a strong option for beginners. In fact, there was an 18-year-old who decided to invest in the S&P 500 instead of chasing trendy stocks. He put in a small amount, didn't check it every day, and just let it sit. 2 years later, his investment had grown by 40% without stress, guessing, or constant monitoring. So if you're unsure where to begin, start with an index fund or ETF. It's low risk, it's simple, and it teaches you how real investing works without needing to time the market or pick winning stocks. Step 4. Automate and stay consistent. One of the biggest secrets to successful investing isn't timing the market, it's staying consistent. And the easiest way to do that is by automating your investments. When you automate, you're setting up your account to invest a fixed amount of money at regular intervals, like every week or every month. This takes the emotion out of investing and builds a habit that runs quietly in the background, no matter what the market is doing. This strategy is called dollar cost averaging, and it works like this. Instead of trying to guess the best time to buy, you invest the same amount regularly. Sometimes you'll buy when prices are high, sometimes when they're low, but over time it averages out and reduces your overall risk. It also protects you from panic, because when markets drop, most people get scared and pull out. But if your investments are on autopilot, you keep buying more shares at a lower price, which actually helps you grow faster when the market recovers. Here's a real example. During a recent recession, a young professional didn't stop her monthly investments. He continued putting in his set amount even when everyone around his was panicking. At first, it looked like he was losing money, but by staying consistent, he ended up buying more shares at cheaper prices. 2 years later, when the market bounced back, his portfolio was worth far more than it would have been if he had stopped. That's the power of consistency and automation working together. It helps you build wealth while staying calm through the ups and downs. So if you're serious about long-term success, set your investment on autopilot and trust the system to work over time. Step 5. Learn as you go without overwhelming yourself. One of the biggest misconceptions about investing is thinking you need to know everything before you begin. That belief holds so many people back, but the truth is, you can start small and learn along the way. You don't need a finance degree or a background in economics. You just need curiosity, patience, and the willingness to keep learning bit by bit. The key is to avoid information overload and focus on trusted sources that explain things clearly. Some great places to start include beginner-friendly YouTube channels, short investing podcasts, and simple newsletters like The Motley Fool or Morning Brew. If you prefer books, check out The Little Book of Common Sense Investing by John Bogle. It's a classic that breaks things down in plain language. And here's a story that proves how powerful this step can be. There was a man who had never invested in his life, not in his 20s, not in his 30s. At 40, he realized he needed to do something for his future, but didn't know where to start. He began watching short investing videos on YouTube, reading articles for beginners, and taking small steps instead of waiting to be an expert. At 42, he made his first investment, not a big one, but enough to get started. Today, he's confident, consistent, and building a solid financial future that once felt impossible. So don't wait to know everything. Start with what you understand, learn a little more each week, and keep going. The journey gets easier the moment you take that first step forward. Common mistakes to avoid as a new investor. Starting your investment journey is exciting, but it's also easy to fall into traps that can slow you down or even cause losses. As a beginner, you don't need to be perfect, but you do need to avoid a few common mistakes that can hurt your progress. One of the biggest mistakes is chasing trends. Many new investors jump into whatever is popular at the moment, hoping to make fast money. This usually leads to buying high and selling low, which is the opposite of what successful investors do. Another mistake is pulling out too soon when the market dips. It's natural to feel nervous when you see your portfolio go down, but reacting emotionally can lock in losses. Smart investors stay in the game and ride out the waves, knowing that markets recover over time. Many beginners also fall into the habit of checking their portfolio every day. This can cause stress and lead to impulsive decisions. Instead, set a schedule to review your investments, like once a month, and focus on the long-term goal. Here's a real-life story that brings this to life. A young investor jumped into cryptocurrency without doing any real research. He followed hype on social media and invested all his savings into a trending coin. Within weeks, the value dropped, and he lost most of his money. But instead of quitting, he decided to learn from the experience. He took time to understand how the market works and shifted his focus to index funds. Now, he's investing with a clear plan and growing his money the steady way. No more chasing shortcuts. So learn from others' mistakes before they become your own. Focus on what works, stay consistent, and avoid decisions driven by fear or hype. Bonus tip: the secret that makes small investors win big. If you've made it this far, here's the bonus tip I promised. And it's a game changer for anyone starting small. It's called dividend reinvesting, and it can quietly grow your portfolio faster than you think. Here's how it works. When you invest in dividend-paying stocks or funds, you'll receive regular payouts. Most people take that cash and let it sit, but smart investors reinvest those dividends to buy more shares automatically. It's like giving your money a raise without doing any extra work. Over time, those extra shares start earning their own dividends too, and the cycle keeps repeating. This creates something powerful called compounding growth, and it works even better when you start early. Let's say you invest in an index fund that pays dividends and enable the DRIP feature, which stands for Dividend Reinvestment Plan. Instead of collecting small payouts, your platform uses them to buy more of the fund for you automatically. No effort, no decisions, just steady growth in the background. This single habit can add thousands to your portfolio over the years, even if you're only investing small amounts each month. It's simple, smart, and one of the most effective strategies for long-term success. So before you finish setting up your investment, check the settings and turn on DRIP. If this helped you take your first step into investing, hit like, subscribe, and share it with a friend who needs this. Drop a comment with how much you're starting with, $5 or $500. Your journey starts today with FinTech Innovate AI. Thanks for watching.